Think about it. The entire financial world, it really relies on trust, right?
Right, absolutely.
And at the heart of that trust, especially in accounting, is ethical conduct. When CPAs, certified public accountants, operate with real integrity, it creates confidence across the whole economy.
Totally agree. And the cornerstone for that integrity, the foundation, is the AICPA Code of Professional Conduct. It's not some dusty rule book nobody looks at. It's
Mhm.
actually a practical guide, helps CPAs navigate, well, the sometimes tricky ethical decisions they face.
Okay, let's unpack this then. In this deep dive, we're going to explore the key parts of the AICPA code. Basically, our mission is to give you, the listener, a clearer picture of what it takes to keep those really crucial ethical and professional standards up.
And it's important to remember this code, it applies really broadly. Doesn't matter if you're in public practice, working inside a business, or even if you're, say, retired.
Even retired.
Yeah, certain parts still apply. These guidelines are relevant. It's meant to be, a comprehensive framework.
Right, and it covers pretty much all the professional services a CPA might provide. Now, there are a few very specific situations where maybe a CPA practicing outside the U.S. might not be held to every single letter,
hmm
but that's usually only when they're following the local rules, the professional standards there.
But, and this is key,
Yeah.
if those services touch on financial statements that sort of imply U.S. standards are being used, then those core rules about following standards and accounting principles, they absolutely still apply.
Gotcha.
Exactly.
Ah.
Because at its core, the code rests on some pretty fundamental principles.
No.
First, and maybe most importantly, serving the public interest.
Okay.
Then you've got integrity acting with honesty, with principle, objectivity and independence, making sure your judgments aren't,
Because,
swayed.
outcome biased.
Precisely.
Hmm.
And finally, do professional care, which basically means you're competent, you're diligent in your work.
The public interest. Okay, so that's not just about the clients you work directly with, is it?
Mhm.
It sounds bigger.
Oh, much bigger. Not at all just the client. It's a much wider circle. Think about anyone who relies on the work CPAs do to make informed decisions.
Like investors, creditors.
Exactly. Investors, creditors, government agencies, even the general public, really. Their trust in the whole profession is, well, it's paramount.
Now, here's where it gets really interesting, I think. The code can't possibly spell out the answer to every single ethical question that might pop up.
No way. Impossible.
So what happens? What does a CPA do when they face a situation that isn't explicitly covered in the rulebook?
That's where this thing called the conceptual framework comes in. It provides a kind of structured approach for dealing with those gray areas.
Okay.
The key is first, you identify any threats to your compliance with the code. Then, critically, you evaluate those threats from the perspective of what a reasonable and informed third party would think.
A reasonable and informed third party.
Yeah, someone objective, knowing all the relevant facts and circumstances.
So basically taking a step back and asking, would someone else, looking at this situation objectively, see a potential ethical problem here?
Precisely. That's the test. And the next step is figuring out if that threat is at what the code calls an acceptable level.
Acceptable level, okay.
If it isn't acceptable, then you must put safeguards in place. The goal is to either eliminate the threat completely or at least reduce it down to that acceptable level.
Safeguards. Okay, what kind of safeguards are we talking about? What tools do CPAs actually have in their toolkit here?
Well, safeguards can come from a few different places.
Mm.
Some are created by the profession itself, laws, regulations, the code itself.
Mm-hmm.
Others might be things implemented by the client you're working with. And finally, your own firm, your employer, should have safeguards in place too.
Ah, so multiple layers.
Exactly. And it's worth noting, you can't just rely on safeguards the client puts in place if the threat is significant. Your firm and the profession, they have a role too.
Makes sense. Now, before we dive deeper into the rules themselves, there are probably a couple of key terms the code uses that are really important to get straight, right?
Absolutely. Definitions matter here. Terms like affiliate and close relative come up a lot, especially when we start talking about independence.
Okay, like affiliate.
Yeah, so an entity is often considered an affiliate if, say, your client controls it. Or maybe if your client has significant influence over it and has a material financial stake in it. It defines the relationship.
And close relative, that sounds specific.
It is. It specifically means your parents, your siblings, or your non-dependent children. These definitions are crucial because they help clarify who might be affected by certain rules, particularly independence rules.
Okay, good to clarify those. So we've kind of got the lay of the land now. Let's dive into some of those specific rules. Maybe start with the general standards.
Sounds good. The general standards rule, it really boils down to a few key things. You need to be competent. You need to exercise due professional care. You need to properly plan and supervise any work you do or work done under you. And you need to obtain sufficient relevant data to actually back up your conclusions or recommendations.
So basically professionalism.
Pretty much. It's about upholding a high level of professionalism in, well, everything you do as a CPA.
Competent.
Yeah.
So that means you actually have the skills and the knowledge needed for whatever task you're taking on.
Yes.
And importantly, if you don't, you need to know when to say, hey, I need help, or this should go to someone else.
Exactly right. It's about having the required expertise, but also being self-aware about your limitations. If a task is genuinely beyond your capabilities, you have a responsibility to either seek assistance or maybe even refer the work to someone who is more qualified.
Okay. And then there's the compliance with standards rule. What does that one require?
This one's pretty straightforward, conceptually at least. It's your obligation as a member to follow the professional standards that are issued by specific designated bodies.
Designated bodies.
Yeah, Appendix A of the code actually lists them out. It includes groups like FAAB, they set accounting standards for the federal government,
Right.
FASB for public and private companies, GASB for state and local governments, the PCAOB, which oversees audits of public companies,
Yeah.
and of course the AICPA's own standards boards like the ASB for auditing, the ARSC for review and compilation, and MCSEC for consulting services.
Wow. Okay. So quite a list.
It is. So
Okay.
it's really about adhering to the established best practices and authoritative guidance in the profession.
So basically stick to the rules set by the folks who really know their specific area. Makes
Yeah.
perfect sense. Okay, next up, integrity and objectivity. This sounds foundational.
It absolutely is. The integrity and objectivity rule is, well, fundamental. It requires you to be free from conflicts of interest, and it prohibits you from knowingly misrepresenting facts.
Knowingly misrepresenting.
Yeah, or allowing your judgment to be subordinated and inappropriately influenced by others.
Conflicts of interest. I can imagine those could pop up in a lot of maybe unexpected ways. How does the code define what a conflict actually is?
Good question. A conflict of interest basically arises when some kind of relationship exists that could potentially compromise your objectivity.
Could. So not necessarily does.
Exactly. It's about the potential. This could come from, say, having interests that are adverse to a client, or maybe acting as an advocate for one client in a way that might harm another client.
Like if you represent two direct competitors.
That could definitely create a conflict, yeah. Or various other situations. The key is the potential impairment of objective judgment.
So it's not just about actual harm done, but even the potential for your judgment to be clouded or perceived as clouded.
Precisely. You need to consider not only conflicts that clearly exist right now, but also situations that could reasonably be perceived by that informed third party as creating a bias.
The code specifically mentions director positions under this rule. Why is that highlighted separately? Seems specific.
Well, serving as a director of an organization can create some pretty inherent conflicts, especially if your accounting firm also provides services to that same organization, or maybe to entities that deal significantly with it.
Because you have duties as a director.
Exactly. As a director, you have fiduciary responsibilities, a duty to act in the best interest of the organization. And those duties might clash directly with your professional responsibility to be objective and independent as a CPA.
So the code advises caution there.
Very much so. It suggests that, in many cases, serving perhaps as a consultant might be more appropriate than actually taking on a board director role to avoid those conflicts.
Okay, makes sense. What about gifts and entertainment? I'm guessing there's some pretty clear boundaries there.
Definitely. Offering or accepting gifts or entertainment, it can lead to what the code calls self-interest threats.
Self-interest, like you feel obligated.
Yeah, you might feel obligated because of the generosity. Or it could create familiarity threats where, a close relationship could cloud your judgment. Or even undue influence threats. If these threats aren't at that acceptable level we talked about, the code essentially presumes that your integrity or objectivity is compromised.
So where's the line? What's just a harmless token of appreciation versus something that, crosses the line?
That is the key question, isn't it? And the code doesn't give you, a specific dollar amount.
Ah,
But it emphasizes that if the gift or entertainment isn't reasonable in the circumstances, it could create an unacceptable threat. You have to consider the nature of it, the value, the intent behind it, the frequency, all that context matters.
context is key.
Yeah.
Okay. Now, what happens if you, as a CPA, disagree with someone you're working with? Maybe your supervisor has a different professional opinion on something important.
That falls under the principle of not subordinating your judgment. It's a really important part of integrity.
Right.
So while you're usually part of a team, you absolutely cannot knowingly misrepresent facts or just let someone else dictate your professional conclusions if you genuinely disagree based on your professional judgment.
So you have to speak up.
You do. If you have a genuine disagreement on a significant matter, you have a responsibility to express your concerns. You should try to resolve it, maybe discuss it with superiors, follow the firm's internal policies.
And if that doesn't work,
In some serious cases, it might even involve considering further escalation. But you always have to do that while being mindful of your confidentiality obligations, of course.
yeah, that sounds like a really delicate balance to strike sometimes.
Okay.
Okay, let's shift gears to a really critical area, especially for CPAs in public practice: independence.
You're absolutely right. Independence is, well, it's vital. It's essential for maintaining public trust, particularly in audit and other attestation services.
Like audits and reviews.
Exactly. The credibility, the whole value of those services really hinges on the CPA's ability to be objective and unbiased in fact and appearance.
We touched on the conceptual framework earlier. How does that specifically guide CPAs when it comes to independence? Is it the same idea?
It's the same fundamental approach, yes. The core question remains: would a reasonable and informed third party, knowing all the relevant facts and circumstances, conclude that the CPA's ability to act with integrity and objectivity is compromised?
Okay.
And if there are threats identified to independence, are there adequate safeguards in place? Safeguards that either eliminate those threats entirely or reduce them to an acceptable level.
So applying that framework specifically to independence, what are some of the specific things, the specific threats that could jeopardize a CPA's independence?
The code identifies several categories. There's the adverse interest threat, where your interests are kind of in opposition to the client's,
Like suing them.
for example. Yeah. Then there's the advocacy threat, where you're maybe promoting the client's interests, like their stock, to the point that your objectivity might be questioned.
Okay.
Familiarity threat, that's where a long or very close relationship with the client could make you too sympathetic, maybe too accepting of their viewpoint.
Too close.
Management participation threat, this is a big one, where you're essentially acting like you're part of the client's management team, making management decisions.
Can't do that.
Definitely not if you're trying to be independent. Then self-interest threat, where you have a financial or other kind of stake in the client's success that might tempt you to bias your work.
Like owning their stock.
Exactly. Self-review threat, that's where you find yourself auditing or reviewing your own prior work, or maybe work done by others in your firm on a non-attest engagement.
Hard to be objective about your own stuff.
Very hard. And finally, the undue influence threat, where the client or maybe someone else is in a position to exert significant pressure on you, maybe coerce you.
Okay, that's a helpful list of categories.
Mhm.
Let's maybe break down some of these with more practical examples. Financial interests seem like a really common area for issues.
They certainly are, and the code gets quite detailed here. It distinguishes between direct financial interests and indirect financial interests.
Direct versus indirect.
Right. A direct financial interest is pretty straightforward. You own the investment directly, like you personally own shares of your audit client's stock.
Okay.
An indirect interest is where you own it through some kind of intermediary, like maybe owning shares in a mutual fund that happens to hold stock in your client.
Huh. Less obvious.
Less obvious, but still potentially problematic. Both types can impair independence, though the rules are often stricter for direct interests, and materiality often plays a role with indirect interests.
And this isn't just about stocks, right?
No, not at all. This extends to things like investments held in client-sponsored retirement or benefit plans, even certain insurance products if they have an investment component linked to a client. And loans, getting loans from or giving loans to clients, that's usually a problem. Even leasing arrangements can sometimes create independence issues.
Wow, okay. Lots to consider there. What about family? You mentioned close relatives earlier.
Yeah.
How does family fit into the independence picture? Like if my spouse owns stock in a company my firm audits,
Yeah, that would very likely cause a problem. The rules are generally strictest for what the code calls immediate family.
which is?
That includes your spouse, spousal equivalent, and dependents. Their financial interests, and often their employment positions, are basically treated as if they were your own when you're assessing independence within a test client.
So spouse owns stock, you own stock for independence purposes.
Generally, yes. For close relatives, remember, parents, siblings, non-dependent kids, the rules are a bit different, often depending on things like whether they hold a key position at the client or if their financial interest is material to their net worth and could influence you.
More nuanced.
It is. And the code also addresses tricky situations like, say, being a trustee for an employee benefit plan or an estate that holds investments in an audit client. In many cases, those underlying investments held by the trust are considered a direct financial interest of the member serving as trustee.
Okay, that makes sense. Let's talk about employment. What about current employment or association with the test clients? What kind of situations does that cover?
This covers a range of things. The most obvious is simultaneously being employed by the attest client while also being part of the firm auditing them. That's a definite no-go.
Right.
Serving on their board of directors, as we discussed earlier, under integrity and objectivity, that also impairs independence. Or even acting as an advisor in a way that's too closely linked to management functions or decision-making.
What about things like staff augmentation, where the firm lends staff to the client?
Yeah, certain staff augmentation arrangements can definitely blur the lines and potentially impair independence, especially if the augmented staff are essentially acting under management's direction or making decisions. The code puts limits on that.
Any other surprising ones?
Maybe things like serving as the treasurer for a political campaign if the candidate is, say, a director or officer of an attest client. That can impair independence, too.
Interesting. Okay, flip side. What happens when someone leaves a company and then joins the accounting firm that audits their former employer?
Yeah, that can certainly create threats, usually self-interest threats, familiarity threats, maybe even undue influence. The person joining the firm knows the client inside out.
So what does the code say?
It requires specific safeguards. The firm needs to make sure that the former employee doesn't have undue influence over the audit, especially regarding matters they were involved with at their old job. This might mean restricting their participation in the audit for a period, ensuring they're not part of the engagement team covering their former responsibilities, or having their work on that engagement reviewed very carefully by someone senior.
Okay, so managing that transition carefully. And what if it goes the other way? Someone on the audit team is maybe thinking about taking a job with the client or actively looking.
That's another tricky situation. If a member of the audit team starts seriously considering or pursuing employment with the attest client, their objectivity could obviously be compromised. They might be thinking about their future job prospects rather than the audit.
Makes sense.
So in such cases, the code generally requires the individual to report this to the firm and immediately remove themselves from the audit engagement until the job offer is either rejected or employment is no longer being sought.
Prompt removal is key. Okay, let's circle back quickly to gifts and entertainment, but specifically for attest clients. Are the rules even stricter here than under the general integrity rule?
The underlying principle is the same. The gift or entertainment shouldn't create a threat that's not at an acceptable level. However, given the critical importance of independence for attest services, the interpretation often means the threshold for what's considered acceptable or clearly insignificant in value is likely lower than it might be in a non-attest context. You have to be extra cautious to avoid even the appearance of impaired independence.
Got it. Extra scrutiny. Now, non-attest services, this always seems like a complex area. The firm provides the audit, but maybe also other services. What can an accounting firm provide to an audit client without messing up independence?
You're right, it is complex and it's a major focus of the independence rules. There are some general requirements that always apply.
Like what?
Like the firm cannot, under any circumstances, take on management responsibilities for the client. The client must agree to oversee the service, designate someone competent internally to do that, evaluate the adequacy of the results, and accept responsibility for those results.
So the client has to stay in the driver's seat.
Exactly. And you need to document the understanding with the client about the nature and extent of the non-ATIS services clearly, usually in writing.
Okay. Then what about specific types of services?
The code then goes into detail on various types: bookkeeping, designing or implementing financial information technology systems, internal audit assistance, appraisal or valuation services, actuarial services, benefit plan administration, litigation support, various tax services. The list goes on.
So let's take an example. Can you do their bookkeeping and audit them?
Generally, providing routine bookkeeping services can be okay if the client takes responsibility and it doesn't involve the firm making management decisions. But if the bookkeeping becomes too involved, or if you're essentially maintaining their entire accounting system, that could impair independence.
What about IT systems? You mentioned that. Can you help them pick accounting software?
Advising on selection, possibly, but designing or implementing a financial information system that generates data significant to the financial statements you'll be auditing, that usually impairs independence.
Because you'd be auditing your own system design.
Exactly. That's a classic self-review threat. The same logic applies to things like preparing source documents or originating data for the client. You can't create the information and then audit it objectively.
What about valuation services? That seems subjective.
It can be. If a valuation service involves a lot of subjectivity and the result is material to the financial statements, performing that service for an audit client would likely impair independence. Think valuing complex financial instruments or significant assets.
Internal audit.
You can provide internal audit assistance, but you can't be the client's internal audit function. Again, it comes back to not performing management functions.
Tax services. Usually okay.
Many tax services are generally permissible, like tax return preparation or providing tax advice. But some, like representing an audit client before a tax court on a controversial matter, might cross the line into advocacy and impair independence. It depends on the specific service.
Okay, so it's really about avoiding management roles, self-review, and advocacy.
Those are definitely key themes running through the non-ADIST service rules, and documentation of the understanding with the client is always critical.
What about those staff augmentation arrangements we mentioned earlier, or agreed-upon procedures engagements? How does independence work there specifically?
For agreed-upon procedures, AUP engagements, the rules are slightly different. Independence isn't automatically impaired just because your firm also provides staff augmentation services to that same client. However, the augmented staff members generally shouldn't be involved in determining the AUP procedures or working on the specific subject matter of that AUP engagement.
Okay, keeping those separate.
Yeah.
Now, what happens if a firm actually messes up? If there is a breach of an independence rule, what are the consequences then?
Well, firms are required to have pretty robust policies and procedures in place precisely to prevent, identify, and deal with breaches.
So, internal controls for independence.
Exactly. If a breach does occur, the firm needs procedures to promptly identify it, communicate it internally, evaluate its significance, and then take action to address the consequences.
What kind of action?
That could range from adding safeguards, maybe removing someone from the team, to, in serious cases, needing to potentially resign from the engagement. And significantly, breaches often need to be communicated to those charged with governance at the client, like the audit committee or the board of directors. Transparency is key.
Okay, wow. We've definitely spent some time on independence, but it's clearly crucial. Let's move on to accounting principles. This seems like it should be straightforward. Just follow GAAP, right? Generally accepted accounting principles.
Generally, yes, that's the core idea. The accounting principles rule basically mandates that if you're associated with financial statements, they need to conform to GAAP for that type of entity.
And GAAP is defined
By those council-designated bodies we talked about earlier, FASB, GASB, FASABA, listed back in Appendix A, you have to adhere to the principles they promulgate.
And if there's no specific rule for something, back to the framework.
Exactly. If there's no specific authoritative guidance for a particular transaction or situation, then the conceptual framework for financial reporting should provide the basis for exercising professional judgment.
But what if, in a really rare specific situation, a CPA genuinely believes that following GAAP to the letter would actually make the financial statements misleading?
That's the exception that proves the rule, kind of. In those very rare circumstances, the code allows for a departure from a promulgated principle. But,
Big but.
huge but, you have a very high burden of proof to justify why following GAAP would be misleading, and you have to fully disclose the departure, the reasons for it, and its effect in the financial statements or your report. It's not taken lightly.
And what about financial statements prepared using something other than GAAP, like a special purpose framework?
The code addresses that too. If statements are prepared under a different recognized framework, like, say, the cash basis or tax basis, you need to make sure that's clearly indicated and not presented in a way that implies they are GAAP statements. Clear communication about the framework used is essential.
Okay, next rule. Acts discreditable. Yeah, that was pretty serious. What kind of actions fall under this umbrella?
Yeah, this rule is intentionally broad because it covers actions that could harm the reputation of the entire accounting profession. It's about maintaining public confidence.
So what are some examples?
Well, things like unlawful discrimination or harassment in employment practices are considered discreditable. Soliciting or improperly disclosing confidential CPA exam questions and answers, big no-no.
Right, cheating the system.
Exactly. Making false or misleading claims about your own qualifications or the services you provide. Failing to follow specific regulatory requirements, especially in areas like governmental audits or SEC practice, can also be deemed discreditable. Using deceptive marketing.
What about client confidentiality if you misuse information?
Absolutely. Misusing confidential information obtained from a client or even from an employer or during volunteer activities without proper authorization. That's a clear violation of the Act's discreditable rule. It damages trust.
The code also mentions record requests, specifically under this rule. What's the main point there?
It basically says you have a professional obligation to handle client records properly. If a client asks for records they provided to you, you generally have to return them promptly.
Even if they haven't paid their bill.
Generally, yes, for client-provided records. You can't hold those hostage over fees. For records you prepared for the client, like tax returns or reports, you should provide those too, though you might be able to charge a reasonable fee for preparation time if they haven't paid. You can't charge for just copying records you already prepared and should have provided. There are nuances depending on state law too, but the principle is don't unreasonably withhold records.
And this also covers things like selling your practice.
Yes, the rule provides guidance on how to handle client records properly during practice sales or mergers, or even when a member leaves a firm to ensure continuity and proper transfer or retention.
Okay, let's talk money. How CPAs get paid. Fees and other remuneration.
Right. We sort of touched on unpaid fees earlier, how they can sometimes create a self-interest threat that impacts independence, especially with the test clients.
Mhm.
But the code also has specific rules about two other types of fees: contingent fees and commissions or referral fees.
Contingent fees where your payment depends on achieving a certain outcome.
Hmm.
When are those allowed and when are they forbidden?
Generally speaking, contingent fees are prohibited for any service performed for an attest client. So no contingent fees if you're doing their audit or review.
Makes sense. Conflict of interest.
Exactly. They're also prohibited for preparing an original tax return, an amended tax return, or a claim for a tax refund for any client. The idea is your fee shouldn't incentivize you to take questionable positions just to get paid or increase your fee.
So no, we only get paid if we find you big tax savings deals.
Generally, no, not for preparing the return or filing the initial refund claim. There are some nuances, particularly around representation in tax examinations by a revenue authority, where contingent fees might be permissible under specific conditions, but the basic rule prohibits them for return prep and initial claims.
Okay. What about commissions or referral fees? Getting paid for recommending products or services or for sending clients elsewhere.
Similar principle about avoiding conflicts. You're generally prohibited from receiving a commission or referral fee for recommending any product or service to an attest client.
Again, independence concern.
Right. And even for non-attest clients, if you accept a referral fee for recommending another CPA's services, or if you pay a referral fee to get a client, you have to disclose that arrangement to the client. Transparency is required for permitted referral fees and commissions.
Disclosure is key. Okay, how about getting the word out? Advertising and other forms of solicitation. What are the main rules there?
The main rule is pretty simple. You can't use advertising or any other form of solicitation that is false, misleading, or deceptive.
Seems reasonable.
Yeah. So you need to be truthful. You need to be able to substantiate any claims you make about your services, your expertise, or your fees. No promising outcomes you can't deliver. No creating unjustified expectations.
Can you mention if you have special credentials?
Absolutely. If you've earned specific AICPA awarded designations like the PFS, Personal Financial Specialist, or others, you can certainly highlight those in your advertising as long as you do it accurately.
Okay, now a really sensitive one. Confidential client information. This must be a cornerstone of the client relationship.
Absolutely fundamental. The confidential client information rule establishes a very clear obligation. You cannot disclose any confidential client information without the specific consent of the client. Protecting that trust is, well, paramount.
Are there any exceptions, situations where you are allowed or even required to disclose client information without their consent?
Yes, there are a few specific limited exceptions carved out.
Such as?
Well, if you receive a valid, legally enforceable subpoena or summons, you likely have to comply. Disclosure is also permitted as part of a professional practice review, peer review, under AICPA or state society auspices.
Okay.
Or if you're responding to an inquiry from an ethics body, like the AICPA or a state board of accountancy during an investigation, or as necessary to initiate or respond to a complaint with such bodies.
What about sharing information with clients? Like, say, in a divorce situation with a joint tax return?
That can be tricky. Generally, if you prepared a joint return, both individuals were your clients at the time, so you can usually provide information from that return to either one. But you need to be careful about information provided solely by one spouse outside the context of the joint return.
And using third-party service providers, like cloud storage or software.
You can use them, but you need to take reasonable steps to ensure the provider has controls in place to protect the confidentiality of the client data. Often involves contractual agreements. The responsibility for confidentiality ultimately still rests with you, the CPA.
Okay. And this also ties into practice sales or mergers, right? Handling that confidential info.
Yes, the rule acknowledges that you might need to disclose some information during due diligence for a sale or merger, but you should take precautions, like using confidentiality agreements with potential buyers or partners.
Makes sense. Let's briefly touch on how a CPA firm itself should be structured and what it can be called. Any rules there?
Yes, the form of organization and name rule. It basically says you have to practice CPA services in a form of organization that's legally permitted in your jurisdiction, like a partnership, LLC, professional corporation, or sole proprietorship. And it has to be consistent with resolutions passed by the AICPA Council. Those are in Appendix B.
Any key requirements from those resolutions?
A big one for firms providing attest services is about ownership. Generally, a majority of the financial interests and voting rights in such a firm must be owned by CPAs.
Majority CPA ownership for a test firm.
Correct. The rule also addresses what constitutes a permissible firm name, basically. It shouldn't be misleading. And it covers how firms that do have non-CPA owners can use the CPA designation, ensuring it's clear that not all owners are necessarily CPAs.
Okay. And finally, what are CPA's responsibilities when it comes to non-CPA professionals working within their firm or under their supervision?
The responsibilities to non-members rule. This is important. If you're an AICPA member and you have non-CPA practitioners working either under your supervision or maybe as partners in your firm,
Yeah.
you can actually be held responsible for their actions if they do something that would have violated the code if they had been a member.
So you're responsible for the ethical conduct of your team.
Essentially, yes. It's your responsibility as the member CPA to ensure that everyone within your practice, member or not, adheres to the relevant ethical standards outlined in the code. You need to provide adequate training and supervision.
Okay, that wraps up the main rules we wanted to cover. So bringing it all together, what's the big picture here, the main takeaway from this whole deep dive into the code?
I think the key takeaway is that the AICPA Code of Professional Conduct is absolutely essential. It's the bedrock for navigating the often complex ethical landscape of the accounting profession.
It's not just about avoiding trouble.
Not at all. It's really about actively upholding the trust that the public, clients, employers, everyone places in CPAs and the work they do. Integrity, objectivity, independence, due care. These aren't just words in the code, they're the pillars of the profession.
We've certainly covered a lot of ground today, haven't we? From those fundamental principles like public interest and integrity, all the way through specific rules on independence, non-attest services, fees, confidentiality.
Yeah, quite a tour.
But as we've kind of hinted throughout, this is really just an overview, isn't it? The code itself is much more detailed.
Exactly right. We've hit the highlights, the main concepts. But we strongly, strongly encourage you, the listener, if these rules apply to you or you're just interested, to actually delve into the full AICPA Code of Professional Conduct. That's where you'll find the complete, thorough understanding of all these ethical and professional obligations.
Yeah, absolutely. So maybe a final thought for you, the listener, to mull over after this.
Well, something to consider is that the business environment, technology, client expectations, it's all changing so rapidly, isn't it?
How constantly?
So the ongoing challenge is how can CPAs ensure that these core principles we've discussed, integrity, objectivity, due care, remain the absolute guiding force in their professional lives, no matter what new pressures or dilemmas emerge? How do you keep that ethical compass calibrated?
That's a powerful question to end on. Keeping that compass true in a changing world. And hey, if you are keen to explore specific scenarios, maybe dive deeper into some really tricky independence issues,
Mhm.
or perhaps ethical challenges in specific industries, do let us know. It could be fodder for future
Yeah.
discussions. For now, thanks for taking this deep dive into the AICPA code with us.